Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Last month, we said that the hurricanes and the fact that there were tens of thousands of workers on strike affected the number, and this month landed exactly where we expected it to land.
The 800-pound gorilla in the room is technology beginning to create some unemployment. What economists would kindly call technological unemployment. It's what everybody worries about, artificial intelligence. Now, we just don't know, but my gut tells me we're probably on the outer edges of that. And that might be why there's some redundancies out there in the workforce.
TikTok could just become kind of a negotiating ping pong between Trump and China to a certain degree. It could set the tone in terms of how certain digital assets from China are perceived by US capital markets. And TikTok is not just the only one. There are other companies such as Temu, such as Shein, and various different other factors that could start to be put on the negotiating table, if you will, as Trump puts this in a bigger kind of scheme of things.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We got a mixed picture here today, Josh. We got, of course, the jobs report this morning, much awaited, and it was pretty much in line with estimates, a little bit better than estimates, although the unemployment rate did tick up. You got a lot of Fed speak also, kind of mixed, I guess. So let's look at the markets, then we can talk a little bit more about that. 148 points is the drop that we're seeing in the Dow today, about a third of 1%. The S&P up a tenth of 1%. The Nasdaq up 0.6 of 1%, but not huge moves here, even though, again, we've been waiting for this jobs report.
Yeah, so I mean, the jobs report was, listen, we know the story that at least a lot of economists on this show have been telling, a market that's moderating, it's cooling, but no signs of crashing. And I think today, you saw that report, Julie, and it feels like a lot of folks concluded, hiring picked up. Okay, the unemployment rate edged up a bit, but maybe they looked through it and decided, you know what, the story for now on that labor market, that narrative seems to be broadly intact.
Yeah, and it does seem like also that the expectation remains intact that the Fed is going to cut at its December meeting and then maybe not cut very much after that. We're seeing a little bit of a drop in the 10-year note for the moment. And that sort of seemed to be borne out by the Fed speak that we got today as well. That seemed to indicate, okay, maybe we'll get another cut and then we'll see what happens next year. If you look at the groups that are on the move today, you got energy down, you got utilities down, consumer discretionary has been on kind of a tear. Amazon is helping lead it higher today. But if you look at the move that we have seen on the week, we're up more than 4%.
Yeah, I do think it's true. I wonder as we go into the weekend too, folks are already with that jobs report, Julie. You mentioned the Fed speak, and we did get, I saw Austin Goolsbee, I think, saying labor market looks broadly stable.
Yes.
I do want to already next week, of course, got the jobs report out of the way. Now you're looking for key inflation data, which is another big piece everybody's going to focus on. Of course, that includes the Fed too.
Yeah, CPI on Wednesday is what we got. And then let's check on crypto as well, right? Because you see a lot of green on your crypto map today. Ethereum getting a little bit of a pop up here above 4,000. Here's the 10% move that we've seen over the past week. It had been lagging some of the other cryptocurrencies. And then, of course, got to talk about Bitcoin here, which went up above 100,000, then came down below, and is now back above it again.
Yeah, and as Trump continues to sort of build out his team here, so obviously, yesterday we heard about David Sachs, you got Paul Atkins, who he wants to lead the SEC. I mean, at least if you're a crypto investor, those are the names you wanted to see.
Yes, those are not things that are going to necessarily slow this down.
Right, exactly.
In their view.
All right, meanwhile, a federal court came to the decision to uphold a law requiring either a sale or ban of TikTok. And Yahoo Finance's Alexis Keenan joins us now with the latest on that.
Hi, guys. Yeah, so this is a district court, a court of appeals in the D.C. circuit saying that they are denying TikTok and TikTok users their request to strike down a U.S. law that was signed into law by President Biden in April, saying that the app would have to either divest to a U.S. owner or eventually be banned. And that deadline is January 19th, so the day before President-elect Trump would be taking office there. TikTok's claim here, they said that this law violated the constitutional protection against free speech, constitutional protection of free speech, rather, and also some other constitutional protections as well. But the court here is saying, no, this law is constitutional, so it is the law of the land. And what it does is it requires not just TikTok to divest, but other apps controlled by foreign adversaries. Those include other apps, prospective apps as well, in China, Russia, North Korea, and Iran, all of them having to divest or face this ban on January 19th. So the three-judge panel here making the decision, they wrote this. They said if the First Amendment exists to protect free speech in the U.S., here, the government acted solely to protect that freedom from a foreign adversary nation and to limit that adversary's ability to gather data on people in the U.S. The court said if it is not divested, the TikTok app, that TikTok's millions of users would have to find alternative media for their communication. There is this little caveat, too, that the court gives President Biden, and that's to have a 90-day extension, put it on pause, but that's only if TikTok is making progress towards this required divestment. Yeah.
So what happens on January 19th?
Yeah. So I mean, January 19th is a fuzzy day.
Like if I have TikTok on my phone, does it stop working?
In theory, yes, but you'd also have to have action happening, right? Someone could run into court and say this has to be shut down, and whether there'll be the motivation to do that at this level, I don't know. But there are some options on the table, not so many right now, maybe looking for President-elect Trump, even if he does want to undo it, right? Because on the campaign trail, he had said that he would save TikTok from this type of repercussion. But this is a law that Congress has passed, that the president has signed into law. So Congress would really have to be brought back in and would have to undo this law. And that would take a lot of, I think, that's a big ask. They just passed it. It's relatively new. So I don't know how much motivation there would be for that either. Also, there could be a chance that TikTok runs into either the Supreme Court or to the Court of Appeals. In the case of the Court of Appeals, they could ask for the full court, right? Because this were just 3 judges on a panel deciding this. They could ask for the full court to hear this. The court does have to grant that request, but what they don't have to grant is a pause. So we don't know if the court would say, okay, we're not going to go forward and enforce this law while it's being litigated. Otherwise, they're going to have to go to the Supreme Court. Again, no guarantee that the Supreme Court is going to take this up.
Whew, okay.
Yeah.
Lots to keep track of. Alexis, thanks for doing that for us.
Sure.
Appreciate it. For more on what may lie ahead for TikTok as it faces that potential ban in the U.S., we've got University of Minnesota Associate Professor of Law, Alan Rosenstein. Alan, thanks for joining us as we try to understand here. So it seems as though the court gave more weight to the government's concern about national security than it did to the claimant's talk about free speech. Is that fair to say how we should be thinking about this?
I think that's mostly right. The court clearly thought that the government's concerns about national security, both the data privacy and the information manipulation concerns, were very serious. But I don't think this is just a story of national security versus free speech. I think this is a story of free speech versus free speech in a sense, because I think at least part of what the court was reacting to was the idea that on the one hand, you did have the free speech interests of TikTok and its users. On the other hand, you had the interests of people on TikTok to not have their platform controlled without them realizing it by a foreign government here, China. And so this was an interesting area in which you had different conceptions of free speech. And I think that's one reason why the court was comfortable with this law.
Alan, let's say this goes to the Supreme Court. 2 questions. 1, do you think they would agree to hear this case? And 2, if they did, Alan, can we make any kind of educated guesses about what their decision might be?
Yeah, so on the first, it is ultimately up to the Supreme Court to decide whether to hear this case. I think it will, though. This is a case of extreme importance, both practically speaking and also in terms of First Amendment law. And over the past couple of years, the Supreme Court has shown a real interest in these kinds of cases. So I would think that they would want to have their word be the last word on this, and not just the DC circuits. But I do think that even though they're likely to take this case, I don't think they're going to do that to reverse the DC circuit. I think they're probably going to uphold it. I think one thing that's notable about the DC Circuit was that you had a 3-0 decision in favor of the government. You had a cross-ideological panel, one judge appointed by President Trump, one judge appointed by President Obama, and then one judge appointed all the way back by President Reagan. And these are 3 of the most experienced and 3 of the most respected judges on the DC Circuit. So I don't really see a reason why the Supreme Court would overturn what the DC Circuit did. Now, they may, in the meantime, pause the law while they deliberate. That's something they often do, especially with laws that can have such a big impact. But I do think that when it comes to when the Supreme Court ultimately decides in this case, which will likely be sometime in the summer of 2025, they will ultimately come down in an opinion that reads very similarly to the opinion that the DC Circuit just issued.
And then if we can sort of extrapolate forward, are there any repercussions or potential repercussions for other Chinese companies that have state ties that operate in the United States?
So the law specifically singles out TikTok and applies to TikTok and ByteDance, but the law also applies potentially to other similar social media companies that are owned or controlled by entities in Russia, China, North Korea, or Iran. And here, really, China is the main story because China is the one that has these popular social media platforms. Now, with those companies, those don't automatically fall under the law. The law gives the president the discretion to designate those companies for a similar kind of divestment or ban. But that being said, there are other substantial Chinese companies that could fall under this. WeChat is an example. And then actually some video games, Fortnite and some other games have this kind of massively multiplayer social media aspect to them that potentially makes them fall under this law. And they are, in many cases, owned by Chinese entities. So if the president here, President Trump, wanted to apply this law to other companies, he potentially could do so.
And Alan, let's say this ban does go through. I'm curious, what is the legal responsibility of the app stores and all this, Alan, Google and Apple?
That's right. So the law, although it's targeted at TikTok, it's enforced against the app stores, Google and Apple, and then also the cloud service providers like Oracle that actually host TikTok in the United States. And they're the ones that have to comply with it. The enforcement mechanism that the law provides is that these companies can be on the hook for up to $5,000 per user. And when you think of TikTok, which has 170 million users, that adds up to a lot of money very quickly. So I would expect on January 19th, unless the law has been paused, for Apple and Google to stop distributing the app and for Oracle to stop hosting TikTok.
Alan, thank you so much. Helpful to get some perspective and context around this. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, Apple reportedly preparing to bring its in-house modem system to market. What that means for some of its competitors on the other side. And shares of Hewlett-Packard Enterprise soaring higher today on the back of its latest earnings report. Company CEO Antonio Neri, we're going to hear from him later in the hour to break down the results. Stick around, much more Market Domination still to come.
Stocks mixed as investors digested the last monthly jobs report of the year. Joining us now to break down those numbers is Thomas Simons, Jefferies senior U.S. economist. Thomas, always good to see you on set.
Likewise. Thank you for having me.
So let's talk about this report. Hiring picks up, unemployment rate or that edges up a bit.
Yeah.
It seemed like a lot of economists kind of looked at the report and decided, you know what? Storyline seems to be intact. Moderating, cooling, not crashing.
Yeah, I mean, we've seen some month-on-month changes in non-farm payrolls for the last year or so that have been really all over the map. Obviously last month with the 12K initial print revised up only a little bit here. We had a big print in September. We had some bigger prints earlier in the year. But if you look at moving averages, 3-month moving average is like 170, 6-month is like 140, and the 12-month is like 190. And then if you think about today's number and you take out the effects of the Boeing strike and the effects of the hurricanes, call it 60K. You're at 167, right? So that's really right in line with that channel. And I don't think that there's anything within the details that suggests there's a big break in momentum anytime soon either.
One interesting thing you point out from the report is the participation rate, and not just overall, among older people in particular. Talk to me about the demographics within this workforce and what effect that's going to have over the next couple of years.
Yeah, I mean, honestly, demographics is like one of my favorite kind of vectors to examine economic data in general, especially as you look in the very long run. It tends to be a very strong predictor of what's going on, right? It's no secret that in every developed market economy in the world, no less the United States, we're heading towards a lower birth rate, higher average age, some faster than others. U.S. actually fortunately benefits from a useful immigration policy, or at least an approach to immigration, I should say, such that we are still relatively young, still growing population. That doesn't change the fact that some 10,000 people hit the age of 65 every day, right? And I remember 10 years ago hearing this stat, and it's still true now, right? And we have about 5 more years of this happening too. So if you look at just like population changes since February 2020, right before the pandemic, there's something like almost 6.1 million more people 65 or older than there were back then, right? And this isn't 6 million more people coming into the United States. This is 6 million people who used to be in the 54 to 64 age bracket, right? So those people are sitting on some $90 trillion worth of wealth. If you look at some of the Fed data on household balance sheets, not all of that is fungible with things that they can use to spend, but certainly they're relatively comfortable. They can and will and are retiring, right? So you have this pull of aging workers coming out of the labor force. For most of this year, we had that offset by all that immigration, but going forward, that's a much more difficult kind of picture to put together.
Yeah, on that point, Tom, I was going to ask you on immigration. With Trump coming back into the White House, obviously immigration is front and center. If he followed through with these plans of mass deportation, as an economist, how do you think about that? The possible ripple effects on the labor market, on wages?
Right. So, I mean, one of the interesting things I think about the immigration debate from this past year was everybody saying, oh, these immigrants came in and they lowered wages, or I shouldn't say that, maybe they reduced wage pressure, right? Like, they provided supply where it wasn't there for labor. And now you kind of think of it in the inverse, which is not only do you have the offset from the retirees, but if there's actual deportations in the scale of million, then you just have very many fewer people, right? One of the things that I pointed out, and I think many others have as well, I'm not going to say this is groundbreaking, but like more population is more people is more aggregate demand. And if they're not producing more than they're necessarily demanding, then that's inflationary, right? So you kind of have these offsetting things that at the end of the day, so long as these kind of changes are relatively in balance, it doesn't actually move the needle in the long run. Like short-term disruption, sure. Now, if Trump actually does that, that's like the point I'm trying to make is millions of fewer people in the U.S. is a terrible thing, right? No country in the history of economic analysis has ever thrived with a shrinking population, let alone one that is shrinking and aging at the same time.
So all of that said,
yes.
When you look at the outlook for where rates are going, assuming, and as you say, it's quite a binary scenario. Either, although you could have the people deported not en masse all at once,
right,
or even all of them, but you are looking at a binary scenario. So what's your base case for inflation and therefore rates going into next year?
So I don't know if this is a cop-out or if it's a kind of out of consensus answer, but I think it's actually relatively similar to what we have right now, right? I mean, I think that we are going to see marginally higher rates, especially in the long run. I do think that the curve is going to steepen a little bit. We're going to get at least a few more rate cuts, so that should bring down the front end. The long end, I'm not super worried about this notion that Trump is going to start spending tons of money and like be extremely fiscally profligate. canceling income tax in favor of like trying to replace that with tariffs. So a lot of math doesn't work on that. And as much as Trump has a lot of unilateral power via the executive order pen, there's still checks and balances in the U.S. government, and there's still a lot of people there that know those aren't great ideas, right? So I think we could end up seeing maybe max upside on the 10-year yield somewhere around 4.5 to 4.75%. We could probably have some scary times like last October when we touched 5 for a brief period of time when everybody suddenly gets worried about supply. But I just really don't see the situation changing, because at the end of the day, you're talking about investing in the most dynamic, best developed and most free market economy in the world. And I would be happy to continue to do that.
Well, we'll see. Fingers crossed. Tom, thanks
Always.
so much.
Thank you.
Good to see you. Appreciate it. Moving on now to Shopify. It's getting a lift as Loop Capital upgrades the stock to a buy, noting that investors are underappreciating how Shopify is utilizing AI. Joining us with more, the analyst behind that note, it's Loop Capital Markets Managing Director Anthony Chicumba. Anthony, this is actually sort of a perfect follow on the conversation we've been having about jobs, because what stood out to me about your Shopify note is not just how Shopify is using AI in terms of its outward-facing services to clients, but how it's using it internally. And as you point out, the company's headcount hasn't changed, but its sales have gone up 20%. So is that just because they're using AI and they don't need to hire people?
It's a really big part of it. And like you said, I mean, it's not just the external, merchant-facing stuff they're doing under Shopify Magic. It's the fact that they're using AI internally, right? So they're using it in their human resources department to respond to employee questions. They're using it in their finance and accounting department. I mean, one of the most stark examples was that the monthly closing process. So large companies like Shopify, they close their financial statements essentially every month, even though they only report them, once a quarter. That process is incredibly laborious. It literally took several hours. Using AI, that's down to minutes. And so there's just, if you have AI and it's making your employees much more efficient, then you don't need to have as many employees. They can continue to grow at these very fast rates while keeping their headcount pretty stable and thus keeping their expense base pretty stable.
And Anthony, one big interesting trend with the company too is the way they're moving Anthony up market. So helping big brands sell online. I'm curious what kind of traction they're seeing there, and also obviously as they move up market there, you are coming to more competition with a Salesforce, with an Adobe.
That's correct. So, basically that enterprise sort of initiative, they roughly, call it Shopify Plus. And here's the thing, we've done a lot of work on Shopify Plus. They just have a better mousetrap than a lot of the other guys out there, than the SAPs, than the Adobes of the world, right? And a lot of it is the fact that whereas like, an SAP or an Adobe, the fact they've been doing it for so long is almost like a disadvantage, right? Like Shopify almost started with kind of a clean slate, when they took this solution that they had originally come up with for small, medium-sized businesses, and they started to apply it to enterprises. The best thing that Shopify has done over the last few years in terms of enterprise is what they call commerce components. So in other words, it used to be if you wanted to switch to Shopify from some other platform, or if you were doing it internally, you essentially, it was almost like a rip and replace. You had to replace kind of everything. Now Shopify has it where if you say, okay, you know what, I'm fine with a lot of my legacy systems, but I just want to replace like the front end, right? The customer facing part of my website, I can do that. Or even if it's just the checkout, I can do that. And so it basically makes it where you don't have to, it doesn't have to be an all or none proposition. And that makes them even more attractive to enterprise merchants.
Anthony, I want to talk a little bit about the holiday season, and maybe I'll segue to it by asking, Shopify obviously does represent some of those bigger enterprises, but it also represents a lot of smaller businesses, companies that aren't publicly traded. And I wonder, are they collectively taking share from the big guys when you look at something like holiday spending?
I'm not so sure about that. I mean, it seems like the big guys are only getting bigger, right? I mean, right now Walmart is taking share from pretty much everyone with, two hands. I mean, there's no bigger retailer in the U.S. I think, quite frankly, in the world than Walmart. So I don't know if that's necessarily happening. It just seems like the bigger getting bigger. And look, we've actually seen a number of better than expected earnings reports, just within the last couple of days, right? I mean, look at the numbers that Ulta Beauty put up yesterday. I mean, certainly much better than we were expecting.
Anthony, just to circle back on Walmart, because listen, we're wrapping up a year here, and what a year for that company. This stock is up more than 80%. What are they doing right, Anthony? They are just simply firing all cylinders here.
Yeah, so I think what Walmart has really done is they've improved their execution. It's their in-store execution, right? It's also their online execution. They also, rolled out that Walmart marketplace, so where third-party sellers could sell on Walmart.com. They've always done a really nice job with click and collect, right? Where you essentially order your groceries online, then you go to the store and they bring them right out. So they really are just hitting on all cylinders in a way that we haven't seen in quite some time.
Well, and what's interesting about that is you could also say, okay, the sort of macroeconomic environment backdrop is good for Walmart too, right? People are looking for value, but you're not seeing all of the players benefit from that kind of phenomenon equally, right? So it's sort of like circumstances plus then execution together, because just circumstances don't seem to be doing it.
You're 100% right, and I definitely have a lot of insight on that because I cover the dollar stores, so Dollar General, and then also Dollar Tree, which owns Family Dollar, and yeah, those companies are not doing well right now. They're really not, and a lot of that I think is that they are giving up market share to Walmart, and a lot of it is because of self-inflicted wounds, right? I mean, look. I mean, Family Dollar. I mean, they've just never been able to. Dollar Tree's never been able to figure out how to run that business, to turn that business around. Now they're trying to sell that business. Dollar General, basically underinvested in store labor for quite some time. The stores got pretty horrific. Now they're trying to kind of turn that around, but you don't just kind of flip a switch. I mean, particularly with a retail that has over 20,000 stores. So you are right. I mean, it is almost like a perfect storm for Walmart where, the macroeconomic environment is still quite difficult, and, they are seeing consumers trade down to Walmart, but they're also benefiting from the fact that a lot of their competitors are kind of shooting themselves in the foot. And by the way, I would throw Target in there as well.
And those two names, Dollar General, Dollar Tree, Anthony, I know you have holds on both of them. Those stocks have been crushed this year, both of them. What would you need to see, I guess, before getting more bullish?
Better numbers, a lot better numbers. I mean, look, in Dollar Tree's case, they need to sell Family Dollar. And by the way, look, they'll take whatever they can get. They would take a bag of magic beans for Family Dollar, and I think that the market would applaud, right? Because the Dollar Tree, the core Dollar Tree business is still operating. I mean, it's slow, but it's still quite decent. With Dollar General, they've got to just continue this turnaround, right? I mean, so for example, they are they've improved their inventory in stock levels. They put more store labor into the stores. They also are sort of decluttering the stores. Like, so for example, they're getting rid of a bunch of stands that are kind of clogging the aisles. So we just need to see better execution from them. And I think if they execute better at the store level, the consumers will come back, because one thing that we haven't seen, quite frankly, is Walmart undercut the dollar stores on price. We do pricing work once a quarter, and the dollar stores are still within spitting distance of Walmart. They're as close as they need to be. So it's not a pricing issue by any stretch of the imagination. It's much more about store level execution.
Anthony, always great to see you and get those stock recommendations. We appreciate it.
Thanks for having me.
Coming up, shares of Hewlett Packard Enterprise, they are soaring higher today on the back of their latest earnings report. The company's CEO, Antonio Neri, joins the show on the other side of the break to break down those results. Stick around, much more market domination still to come.
One of the hottest tickers on the Yahoo Finance platform is HPE after the company's latest earnings report and forward guidance. Let's get to HPE CEO Antonio Neri. And Antonio, always good to see you here. Thanks for joining Yahoo Finance. What stood out to me amongst many things in this quarter is your server performance. Really strong. Is that the power? Are investors, I guess, getting a taste of the power of AI and how it's going to impact businesses like yours?
Well, thank you for having me, Brian. It's not just servers, I will say. I think when you look at our performance in Q4 was exceptional on many, many metrics. Servers obviously was the flagship with AI, but also hybrid cloud did extremely well, including GreenLake and storage. But when it comes to AI, I think the market comes to recognize that HP has a right to play because of our unique innovation, intellectual properties, and capabilities. And then ultimately, we see the momentum happening across multiple segments of the markets, including now enterprise, which we saw a significant uptick in our pipeline, and now first deals through our HP Private Cloud AI. So I'm really pleased about the quarter. We delivered record-breaking performance on revenues, 8.5 billion. In that number, we had the 4.7 on servers, record profitability of $938 million. And then for the full year, we exceeded our commitments on revenue, EPS, both GAAP and non-GAAP, and record-breaking free cash flow. So we are very excited about 2025, Brian.
When you talk to your fellow CEOs, what are they asking you about AI, and then how have the conversations changed with them compared to 3 months ago?
Well, I think, we all address different segments of the markets, but remember, I think about AI in 4 unique, distinct segments. Number one is companies that are in the business to build this large language model. I call the large language model builders or the hyperscalers. Obviously, they lead with the latest technology because they want the best performance at scale with lower energy consumption and ultimately reduce the cost of training, right? And then you have sovereign AI, which obviously is now coming very strong on interest. And we already building 2 very large sovereign AI clouds for Japan and the UK, but more in the pipeline. But what I was really pleased is the fact that now enterprise is deploying AI, including ourselves, right? We have many, many, many use cases, many of them already in production. But I think in that segment of the market, Brian, they're looking for time to value and simplicity of the offer because they don't have the whole expertise.
These AI models, as you know, Antonio, they're sucking up a lot of energy.
Yeah.
Are we headed towards some form of energy crisis here? As all this stuff is converging and AI is penetrating our lives in new ways?
Well, definitely the path we are on is now sustainable unless we innovate around the entire ecosystem. And when I think about the entire ecosystem is sources of energy, which obviously needs to be clean. It's not just more capacity, but it also needs to be clean from the way we power these data centers. The actual architecture of these systems moving to direct liquid cooling, and there HP has unique play because we are the industry first with 100% fanless direct liquid cooling, including the switching, by the way, the networking part, not just GPUs and CPUs. And that when you go to that architecture, we have proven that you can reduce energy consumption by 90% and space by 50%. So this is why we got to innovate across the entire ecosystem. Otherwise, it's not sustainable.
How hopeful are you that the new administration coming in, they have the policies that will help unlock this United States type of investment?
Definitely, we need to invest more. The current administration now in transition started that process with the CHIPS Act and the Life Science Act and other supports into the infrastructure. But I'm hopeful with the new administration, we're going to see an acceleration of that. Also because it's important from a U.S. national security perspective as AI is deployed everywhere. And this is why a transaction like ours with Juniper Network is important for the United States because it brings more pro-competitive, allows us to stay ahead of the game, especially as we build these massive supercomputers. Remember that HP now has 7 of the top 10 supercomputers deployed in the world. And number 1, number 2, and number 3 is in the United States.
Those computers sound a lot more powerful than what Enrique's selling over at HP there, Antonio. Well, I'm just got to say it. You didn't have to say it. I'll say it. But you mentioned Juniper. There was an FT story, I'm sure you saw it 2 weeks ago. Officials at HPE reportedly met with officials in the government. There was maybe perhaps some concern if this deal is going to get done. We've talked to you every step of the way. Does this deal get closed in January?
We believe the deal will get closed in the early part of 2025 within the original timelines we provided. Remember, when I announced the intent to acquire Juniper on January 10th, we said that we expect the deal to close the latter part of 2024, calendar 24, or early part of 2025. We have received pretty much all the approval outside the United States with unconditional support, which means they see the deal as a pro-competitive. And we have been working with the DOJ incredibly collaboratively to answer all the questions. Obviously, have been busy dealing with many cases, but the reality is that we still believe the deal will close in the early part of 2025, and nothing gives me pause that would not be the case, because the deal is pro-competitive, and as I said earlier, also supports our U.S. national interests.
Let's assume this deal does close, Antonio. What do the next couple quarters after the deal closing look like for HPE? I mean, do you get an earnings relift? Do you anticipate the stock to re-rate?
Well, over time, we expect the stock to re-rate because obviously we'll be adding $5 billion to the company. Remember, we just announced fiscal year 24 results at $30 billion. And that $5 billion comes with a different structural margin, which ultimately the stock P multiple will have to re-rate. But, it would not be immediate. It will take some time. Also because we have a number of synergies that we committed, which last time we talked about it, we said at least $450 million. And this is why, Brian, we only guided Q1, because we are confident that we can close the deal. And hopefully by the time we announce Q1, the deal will be closed. And that point in time, we're going to guide for the rest of 25 and obviously 26 and 27.
How important is Intel to the country's, I guess, supply chain ecosystem? I mean, Pat Gelsinger, he retired earlier in the week. Sources told me that, it maybe wasn't actual retirement, but the company's struggling. I mean, how important is it to a company like yours? I know you work with NVIDIA, but how important is a company like yours? How important is it to the country that company turns itself around and does it somewhat quickly?
Yeah. Well, I can't comment on what happened inside Intel, but I have tremendous respect for Pat, for what he has done at Intel, at VMware, and the broader tech industry. He is a unique personality with unwavering integrity and so forth. So, but coming back to Intel, I will say we need Intel because the market needs Intel. Customer needs more competition in this space, and the United States needs a healthy Intel.
Antonio Neri, HPE CEO, always great to get some time with you. Happy holidays. Thanks for making time for Yahoo Finance. We'll talk to you soon.
Thank you, Brian. Happy holidays to you and your family.
Thank you so much. All right, Julie, Josh, back to you.
Apple reportedly preparing to bring its in-house modem system to market. Qualcomm shares under pressure as Apple looks to replace components from its longtime partner. Here with more Yahoo Finance's Dan Hellion. And Dan, we sort of knew that this was in the works, but this report today has more details, especially on things like the timeline.
Yeah, Julie, this has been something that Apple's been trying to cook up for a long time and just kind of kept hitting a wall when it came to replacing Qualcomm and with its own in-house modem. Obviously, a modem is something that connects a phone to 5G or 4G networks so that you can get online and endlessly scroll something like Instagram, not TikTok maybe for long. But this is something that is going to end up, according to Bloomberg, showing up first in iPhones in the upcoming iPhone SE. That's the entry-level iPhone that Apple has left to kind of sit and languish for a while, not updating it very often. It's expected to be the first one to get that new modem, and then it should come in the upcoming iPhone 17, which would be landing in late 2025. And so you can expect this modem to kind of shave down some of the size of the iPhone. There could be battery life improvements, maybe not if they're cutting down on the size. Maybe it'll be, just a little bit better. Maybe, kind of just the same. But really cutting down on the size is something that has been repeatedly reported for the next generation iPhone, a new physical look to it. And it's something, obviously, when it comes to the design, display, battery, and camera, those are the things that people really go out and buy a new phone for, and a new design could really start to goose sales. And then on the Qualcomm side of things, well, they still make a ton of money. I think about 20% of revenue from that iPhone deal that they have. And so they've been aware of this for some time. You can see from the messaging that Qualcomm's been pushing as of late that they're trying to be known as more than just a handset chip company. During their investor day a few weeks back, they had basically said, look, we're in the PC space, we're developing more there, we're in the auto space, we're developing more there, and they expect to see growth in those sectors as the smartphone area continues to stagnate. So obviously Qualcomm trying to get ahead of these reports, knowing that investors would say, well, you're losing this huge client, what does that mean for your bottom line? And Qualcomm saying, we're working on it. We have places where we can pick up the slack in other areas, especially as we dive deeper into PCs and autos. So it seems to be a win for Apple, a loss for Qualcomm, but they're aware of that and likely to be picking things up in other areas.
Right, and then there are some other suppliers like Qorvo also that were taking a little bit of a hit today, but Qualcomm, the one that is most closely linked to Apple historically in that way. Dan, thank you so much. Appreciate it. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most trafficked stocks of the session on Yahoo Finance's trending tickers page. Lululemon shares surging on the back of strong third quarter results. The company also raised its full year revenue forecast. And I had the chance to talk to the CEO, Calvin McDonald, this morning. The company has been seeing very strong results in China, but also importantly, a possible inflection in the United States. Here's what he said.
There's no doubt in my mind that we have a long runway of growth still in the Americas and in particular in US. When we look at our growth around the globe, as you mentioned, we're growing in every market, double digit, 39% in mainland China, 24% in rest of world, 9% in Canada, and we're growing men's in the US. Our opportunity is in women's in the US.
So that's what they're focusing on now, Josh. What's interesting is not all analysts are convinced that they're going to be able to really flip that business back to growth like it has seen.
China was, the big headline that dropped. It jumped about almost 40%. What explained that?
Basically, McDonald talked about the value of the brand in China, and he said also their brand is not yet that well known, so he looks for even more upside. But they do things like events. They do them globally, but in China, it seems like they've really tried to peg in-store activities, events, activations, try to get customers there engaged. And it just seems to be working. So that part of the business is definitely
Look at that chart
a
as well,
bright
by the way.
spot. Yeah, over the past month, we've definitely seen
What a move.
big uptick in the shares, but still on the year, they're down, about 20%.
Yeah. Julie, thank you. And stick around, more market domination still to come.
seeing some big name earnings next week in the software sector, including Oracle and Adobe. And artificial intelligence will, of course, be a focus of both reports for investors. Our next guest is calling 2025 the year of the AI agent. So which companies are best positioned in this AI revolution? We're navigating how to play the software sector with the Yahoo Finance Playbook. And joining us now, Stefan Slowinski. He's Global Head of Software Research at BNP Paribas Exane. Thank you so much for being here.
Thanks, Julie. Nice to be here.
So big picture for software, it's been kind of a lumpy year in 2024, but it sounds like you're more optimistic for where we're going next year.
It has been a lumpy year. I think the sector hit a low in May. There was lots of pessimism around demand, around monetization of co-pilots, which didn't really pan out, and actually around disruption to the business model. And it's pretty safe to say that in 6 months we've done a 180-degree turn. And so the software sector, the IGV is up 40% since the end of May. Obviously improved outlook on the demand front, or we hope so at least in the US, although Europe remains a bit sluggish. And hope that the AI agents are finally the killer app that allows companies to monetize Gen AI. So we've seen that turn in sentiment. The problem is it's already reflected in a lot of the share prices.
Right.
And is that why, let's get to some of those names. So I'm like Adobe, for example. You got the equivalent of a sell on that name. Is that, I mean, the stock has been obviously a laggard this year. Is that more about the big existential threat from AI? Is that the worry?
Yeah, we have been underperformed this year, and I think for a lot of these software stocks, they've been riding these what we call these waves of disruption. One moment they're seen as an AI winner, the next moment they're seen as an AI loser. And part of our concern around Adobe is just the increasing competition from the hyperscalers. So literally every day we're seeing Meta, we're seeing Google, we're seeing Amazon this week coming out with models around content creation, content editing, video creation, video editing, working that into advertising workflows. And so that's just a space where Adobe will have a role to play, but it's just getting a bit more competitive, which is why we're cautious.
What is Adobe's response to that?
Adobe says that and they are crucial to the enterprise customer, and we believe that they will be. They obviously have their own Firefly model, which they've created based on data that they own and therefore can be trusted by their users. And again, I think that will resonate very well with a lot of their enterprise customers, but we're worried a bit more about some of the casual, non-professional users who may go to some of these other options, or even small businesses. Look, last quarter, Meta said that 1 million advertisers were using their tools to create content. And so that's just potentially going to be a headwind to growth.
So let's get to that killer app idea that the agent AI is what, at least one of the first things that we know what AI is for, and that's one of those things. How is that playing out? Who's benefiting from it the most, and how are they benefiting? How are they using it?
First of all, it's early.
Yeah.
Second of all, co-pilots, of course, 18 months ago was what everyone was talking about, and these were supposed to be AI tools to help each of us in our day-to-day work and help us become a bit more efficient, a bit more productive. I think the selling point for CEOs and CFOs maybe wasn't strong enough for them to fully believe in it. But with AI agents, it does become more about automating roles. You heard Mark Benioff the other night talking about digital labor forces. So we are talking about agents becoming more replacement for some employees. And so, socially, of course, that creates some questions. But you can understand how CEOs and CFOs are now seeing this technology as the value proposition, the ability to sell it based on that return is more attractive.
Another name, Stefan, I'm so interested to get your take on is Meta, because you have the equivalent of a sell on there too. And I think a lot of people, when they saw those last results, they liked what they saw with the top and bottom line. So is that a valuation call? Is it concerns about CapEx? Because on AI, just stick with that thing, there's bulls who come on this show, Stefan, and they pound the table and say, hey, that's one of the names where I see all the spending have results on engagement and advertiser efficiency.
Yeah, absolutely. So we're an underperform, so it's a relative call. A couple of concerns that we do have. One is their business model is still 99% advertising. So whereas Microsoft and Google and Amazon have the enterprise cloud computing businesses, they have a way of monetizing this already with their enterprise customers. Some of those other hyperscalers have subscription business models like Google, Amazon with Prime. They already have subscription models for consumers, so they can maybe layer in Gen AI and get people to pay for that via subscription. Meta hasn't yet developed that. That's one thing. The second thing is we are waiting for January. They will be guiding on CapEx and OpEx for next year. We expect that to be a pretty big number. And so if the top line holds up for them, that's fine. But obviously, if we get any disappointment on the top line, investors may start to get a bit spooked about the spending. You're still losing $20 billion a year on Reality Labs. And so again, relative to some of those other names, that's one that we have it underperform on.
So Josh keeps asking about what you don't like. I'm going to ask you what you do, what you do like. You alluded to Salesforce.
Yes.
We mentioned Oracle's coming next week. I believe you have outperforms on both of those.
That's right.
So let's take Salesforce first. What are they? I mean, they seem to have gotten more popular.
Yeah, so they've certainly gone from the loser category back in May to now the winner category here in December. First of all, from a valuation standpoint, you still do have some backstop, meaning on a free cash flow multiple basis, the stock is still reasonable. And so yes, we are starting to embed more hope and expectation, but at the same time, valuation is still reasonable. They are coming out with Agentforce, which is their platform to build AI agents. They're running at that 100 miles an hour. And the initial, again, it's very early, but the initial feedback has been quite positive. So that's one that we expect potentially could see revenue growth acceleration in the second half of the year. And Oracle's already seeing that revenue growth acceleration. Some of that is mechanical with Oracle Cloud Infrastructure growing at close to 50% and becoming a bigger portion of the business. But I think when you do look at next year, because of where valuations have run, you need to be confident that the company you're investing in will see revenue growth accelerate. We think that's the case with Oracle, and with Salesforce, probably the back half of the year we could start to see that happen.
Great year for Larry Ellison, Schafer Katz.
Absolutely.
What a rocket ship. Stefan, thank you so much. Appreciate it.
Great, thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There is the closing bell on Wall Street on this Friday. It is market domination overtime now. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. The Dow, the laggard of the session, off by 0.25%. That's about 123 points. The S&P 500 up by 0.25%. And the Nasdaq leading up 0.8%. And the Nasdaq has really come back this week, up by 3.3% here. We've been talking for a while now about the broadening out of the rally, but that broadening kind of stalled this week. And the Nasdaq was up 3.3%. Contrast that with the S&P equal weight index down 1.25%. So it was large cap tech that came back. We've been talking about this sort of day by day as it's been happening, but now I think it's official. It's a trend on the week, Jared. We'll see if it continues beyond this week.
Yes, I was looking at tech all week long. It's been an interesting mix because you can break it into a few different categories. And let's just skip right to that. I'm going to show you the semiconductors on a 5-day basis. And we're going to see a lot of green here. NVIDIA up 3%, Broadcom up 10%. Software did better. And we can see bigger numbers here. Datadog up 10%, Workday up 6.6%, Salesforce up 10%, just talking about that. And then we have unprofitable tech. Aside from Tesla, most of these are very small issuers, and we're seeing the outsized performance from the smaller ones. DNA up 34%, Roku over 20%, Roblox up over 18%, Coinbase 16%. We've also seen this strength in crypto. Looks like Bitcoin is once again knocking on 100,000, actually above 100,000, and we can see that 5-day total for Bitcoin about 5%, and it is trading at 101,500, not quite the 104,000, just short of that we saw the other day. But let's get to the sector action. This is what we're seeing during the week, and it's been about the mega caps. In terms of large cap, Julie, we are seeing the biggest outperformance in consumer discretionary. That's XLY, followed by tech, and then we also have communication services outperforming. But you're going to see most of the sectors up here, they are red this week. So in terms of large caps, it was just the largest of the large, and we see that in the Nasdaq 100, where you take a look at the left hand, and you can see this outperformance by some of these mega caps. Meta really among the leaders here, up 8.6%. Tesla up almost 13%. By the way, Tesla almost up to its record highs that we had all the way back in 2021. So I'm going to send it off to you, Josh, on that note.
Thank you, Jared. Now for a closer look here, mixed moves on Wall Street to round out the week, and for the bond market, yields edging lower as investors consider the future of the Fed's rate cut path. The odds of a cut rising in a few weeks after the November jobs report came in just above economists' expectations. And joining us now to talk about all this is RJ Gallo, Federated Hermes Senior Portfolio Manager. RJ, good to see you. So let's start on that jobs report. RJ, I'm curious what you made of it. Did it come in about as you expected, RJ? What do you think the Fed makes of it?
Well, I think that the report was generally favorable. I know yields came down on the release. But I would say that at this point, we have a trailing 3-month average increase in non-farm payrolls of 173,000. Historically, that's a pretty healthy number. Admittedly, it's slower, less job growth than 6 months ago or 12 months ago, but everybody knew that the jobs market had to slow down some, and it's still soundly expanding and I think generally healthy. I think the Fed would probably view this release as consistent with their already underway process of easing policy to become less restrictive. As the labor market has softened compared to where it was, but is still reasonably healthy, they are easing to try to secure the soft landing and prevent a little bit of a labor market slowdown from turning into something worse, keeping the disinflation in train and keeping the economy in an expansion mode in a manner that's consistent with both of their objectives. Monetary policy is shooting for maximum employment and price stability, and we're getting close on both. And the employment side is generally pretty good, even though the unemployment rate did tick up to a still low 4.2.
I mean, at the same time, there's a little bit of like a spinning plates vibe to the whole thing, RJ, because, inflation kind of has stalled out at where it is, right? And jobs, admittedly, as you say, while it's remaining relatively healthy, we don't know where it's going yet. It looks like that the preponderance of folks think that there is going to be a cut at this December meeting from the Fed. Do you think that's what's going to happen? And do you think that there are any risks to that cut?
I think it's highly, highly likely. And the market agrees. If you look at the pricing of futures, that are priced relative to Fed funds rates expectations. It's highly likely that there will be another 25 basis point cut at the December FOMC meeting. Now, number one, the Fed funds rate is still well above the rates of inflation. The rates of inflation have not yet gotten to the Fed's 2% on core PCE or headline PCE, but they are basically half of where they were not all that long ago. I think that the Fed is of the view that a positive real Fed funds rate of the magnitude we currently have could be undesirably restrictive. And so their interest now is to become less restrictive. They're not easing to fight a recession. They're easing to try to achieve a soft landing. I would argue the soft landing pretty much has been achieved. The only lingering question is, will inflation get right back to 2%? Or will the Fed basically say, hey, we're comfortable with an inflation rate of 2 to 2.5%. Let's not get too precise here. If we can get disinflation of the sort that we've already had, an inflation rate 2 to 2.5%, and the unemployment rate ends up in staying in the low 4% range, I think that that would be mission accomplished to the Fed. And I think that the ease coming in December is part of that. The bigger question is, where do we go next year? How far down in interest rate space will the Fed funds rate go? The markets at one point thought that the Fed would take yields down to below 3% for the Fed funds rate. That is no longer the expectation. And I think another key aspect of next month's the Fed meeting in a couple weeks here is what does the Fed tell us via the dot plot? Where do interest rates go in terms of their projections for the end of 25 and for the end of 26? There's a good chance they're going to increase pretty sharply from the last projections that were shared with us back at the September meeting. And that's something that could be a challenge to the bond market. If the Fed tells us they're not going to take rates as low as we once had hoped, that could push back a little bit on the recent drop in bond yields as the Fed revealed that message.
And so, RJ, add it up to us, given your views there of the Fed, the economy, for fixed income investors who are listening right now, your advice is what, RJ?
Well, first of all, bonds have produced about, diversified bond portfolios, 3.5% rates of total return this year. That's not very good compared to the, north of almost 30% return you're getting off of an S&P 500 equity investment. I think the better comparison right now, given what we have been through, we went through an extraordinarily adversarial period of surging inflation, massive Fed tightening, and double-digit losses on nearly every fixed income asset class in 2022. Since then, we have found our feet. Income has been restored as a driver of total return in the bond asset class. That's the benefit of the fact that interest rates had to rise rapidly as the Fed fought inflation. So where we stand today, you actually have income providing a tailwind to your total return. That wasn't true when the 10-year Treasury was below 1% in yield. It is true when it's above 4% in yield. So I think fixed income has a place in your portfolio. I think plenty of investors have benefited from being heavily in cash or heavily in stocks, or some, barbell between those two. I think at this point in time, with stock valuations high, with a lot of policy uncertainty, it seems to me an equity investor could take some chips off the table and buy a bond market where income is going to give them a lower rate of return than stocks if stocks keep taking off, but will also manage their risk if stocks roll over. Conversely, a cash investor, and we love cash investors at Federated Hermes, we manage a lot of money market mutual funds, but the returns on those funds are going to go down as the Fed keeps easing. That means that we're going to hit a crossover point where bond investments with a little bit of interest rate risk duration can give you a better total return than your cash. So the cash investor can also look to move out to short-term bonds or intermediate bonds, diversify their risk profile, and get some upside compared to staying in cash as returns to cash decline.
RJ, thanks a lot. Have a great weekend.
Thank you.
Employers hired 227,000 folks in November, slightly more than economists expected, with Wall Street hoping a Goldilocks employment scenario will still allow the Federal Reserve to trim interest rates. However, there may also be signs that a cool down is underway, potentially. Joining us now, Yahoo Finance's Rick Newman. What are those signs that you're seeing there, Rick?
Hey, guys. Well, some of the more bearish economists I follow acknowledge, yes, we had a good monthly jobs report, but There's some questions about the methodology in this report. We can get into that later in another segment if you guys ever want to. But there are other measures of hiring in the economy that are much broader than the monthly number and much more reliable. And those show we are actually close to tipping into a danger zone. If you look at year-over-year change in employment growth, it is very small. The increases are very small. You can see it. You can see it in that chart there. So the question is, that line, where that line is going down toward the right-hand side, are we at a point where that might cross the 0 point and we might actually get into negative year-over-year employment growth? There's no sign a recession is imminent, but it's also true that we've seen curves like that or charts like that right before other recessions, such as the one that began in 2007 or the one that began in 2001. And while a lot of our audience follows the Federal Reserve, I'm following the Biden handoff to Donald Trump as he's coming in January, and just wondering, it looks like Trump's going to inherit a pretty good economy, but there are some warning signs. So I'm watching those charts.
Rick, I'm curious because I haven't gotten your take yet on what you think of the kind of core economic team Trump has assembled. I ask because, it's kind of top of mind, Rick. We had Anthony Scaramucci on the show this week, and obviously Scaramucci, not a fan of Trump. But it's interesting.
Not anymore.
No, sure not. But interesting because even Scaramucci, he was talking about Trump's team on X, Besson, Hassett, Atkins, and even a skeptic like Scaramucci said he was impressed by that team. And I'm just curious to get your general thoughts on it.
Yeah, the flaky nominees are not on the economic team. I mean, I think the most obvious ones are Pete Hegseth for Defense Secretary. He's got zero experience managing a large organization. Kash Patel at the FBI. I mean, these are the sort of Trumpy America First people who are just there because they're out of loyalty to Trump. The economic team, I think, is reassuring. I mean, Scott Bessent as a Treasury Secretary, markets like him, and we saw a favorable market reaction when he was named as the Treasury Secretary. Yes, we are going to get some tariffs and a lot of tariff threats, but the guys on the economic team have been there before, and they're sort of known quantities. So that suggests the markets are probably going to be okay. If we're going to have turmoil under Trump, it's probably going to be in some other part of the government.
Rick, always great to see you and have you on the show. Have a great weekend.
Guys. See you.
And be sure to check out Rick Newman on the Yahoo Finance podcast, Capital Gains. This week, the team is joined by Raymond James Washington policy analyst and managing director Edward Mills to discuss Trump's tariffs. You can scan the QR code below to stay up to date with the latest episodes, and be sure to tune in every Friday at 12 p.m. Here's a clip from this week's episode.
What I've told clients here at Raymond James is to rank order some of the tariffs. Number 1, China. Number 2, Mexico, and I guess I have to add Canada after the Truth Social post of last week. Number 3, Europe. Number 4, the rest of the world. When I've talked to Trump trade experts, folks that worked with him in his first term, they tell me, again, take him seriously. Don't take him literally. Not everything that gets posted is going to get implemented. But I will tell you, if we do this interview a year from today, there will be more tariffs in place than there are today. And we'll probably have a conversation about Congress giving him additional tariff authority as they pass an extension of the 2017 tax cuts that expire on December 31st of next year.
Business leaders across the materials and industrial space are here at Goldman's conference as the industry looks ahead to 2025 and the incoming Trump administration. From tariffs to various regulation changes that we are expecting to infrastructure, what could these policy changes mean here for this sector? I want to bring in Joe Ritchie. He is Goldman's co-head of U.S. Industrials and Materials Investment Research. Joe, it's great to have you. Thank you so much for making the time.
Shauna, great to see you again.
So there's lots to get into here. I know you've been very busy with the conversations that you've been having over the last 2 days. I'm curious just to get your assessment right now of the industrial space and whether or not maybe the worst that we have seen is that behind the sector.
Look, from a macro perspective, the reality is that the ISM has been down for 24 out of the last 25 months. So a lot of investors that are here today are looking to see that inflection, right? We've had multiple companies on stage the last 2 days. I'd say cautious optimism is where we're at today. You know, we've had several companies say we're expecting better growth in 2025, but the reality is that they're not really seeing it in their businesses today. As we've spoken before, we're very bullish on what's happening from a U.S. manufacturing perspective here in the U.S. So it's only a matter of time before it happens, and we think it'll inflect at some point in 2025.
What is that manufacturing renaissance? Because it's something you and I talked about 17, 18 months ago. What does that phase look like here as we enter 2025, and how you see that playing out?
Yeah, so let me put some context around it. Historically, in the U.S., we've spent roughly around $70 to $80 billion a year in manufacturing investment. And right now, we're tracking projects that are greater than $1 billion, tracking to roughly $270 billion that have broken ground. If you've actually taken a look at what investment has looked like over the last few years, the reality is manufacturing investment has already started to tick up. So last year, it was somewhere between 190 to 200 billion. This year, we're looking at close to 230 to 240 billion. The important part for the companies that we look at, and these are the HVAC companies, the electrical companies that really do the guts of the facilities and then also sell into the factory floor. The reality is for those companies, they've yet to see the inflection in their orders. A lot of the investment today has been on structures, which benefits companies like concrete, steel, you'll see the aggregate names also benefit as well. So we think a lot of the goodness right now from the manufacturing perspective is on the come for the companies that we cover.
If we do see some of the tariff threats that have been put out here by the incoming Trump administration, are some of the companies within your coverage maybe better positioned, I would guess, than others, just given where they do have their manufacturing plants? And I guess of that, how big of an overhang is that, more broadly speaking?
Yeah, so it's obviously been super topical, given that we're only about a month removed from the election. The reality for a lot of our companies are insulated, and you go back to the last tariff cycle, they didn't really see a material impact to their P&L. You have some companies like Stanley Black & Decker, which is more a consumer-levered industrial, which has said like they're already dealing with 25% tariffs, and they import roughly, call it 25 to 30% of their cost of goods sold is imported here into the U.S. from China. If we were to increase tariffs to 60%, that's roughly a $200 million cost hit to Stanley. And the reality is that they're going to try to price, they're going to try to change their supply chain in order to offset that. That'll take time, right? But the majority of our companies, pretty well insulated. You have some manufacturing that's happening in Mexico, but the reality is a lot of our companies are actually in pretty good shape.
What are you hearing just from CEOs and the various executives who are here today, those who do have exposure to this potential threat? Are they already moving on that? I mean, how are they navigating this uncertain time?
Yeah, I mean, it's so hard right now. They're having conversations with their channel partners to discuss what pricing could look like if under different types of scenarios. But the reality is until you have something that's a little bit more finite, it's tough to actually institute anything. So Stanley is a great example of that. They're having discussions with the Home Depots, the Lowe's of the world already. I would assume that it's probably easier for them to get pricing through this time around versus last time, just because we have a playbook for tariffs. It's not new. But until you actually know exactly what's going to come down the pipeline, it's really difficult to make any decisions longer term.
Joe, what's the sentiment from business leaders about the incoming Trump administration? Overall, do they view this as good for business? How should investors be thinking about that?
I mean, the stock market seriously is
they're excited about it.
Yeah, the market's certainly excited about it. I think. Look, I think the reality is a lot of the business leaders are measured. And so I had Honeywell here today as an example. We met with their DC team in late September. And the reality is that, they were well positioned on both sides of the aisle. I think a lot of our companies are like that. And so sure, there's optimism. I'd say that the areas of the economy that are probably going to benefit a little bit more are some of the kind of like more traditional oil and gas type names. And so I had Flowserve here today. I think that they view the election as a net positive for them, even if there are increases in tariffs. But generally speaking, I think that the backdrop and the feeling regarding this new regime is fairly positive.
How do you see companies accelerating their growth? When we're trying to identify just the biggest catalyst within the sector, is it M&A? How do you see that strategy evolving?
So it's a combination of new product introductions, investing organically, and M&A. So the reality is the sector that I cover, this multi-industry sector, is a list of industrial conglomerates. And what you've seen happening over the course of the past decade is they've been deconglomerizing. And the companies that were faster to move with changing their portfolio to become much more focused companies have benefited in this upcycle from a growth perspective and having better margins as well. So what you're seeing is you're actually seeing a ton of portfolio movement. I mean, I had like roughly 20 companies here. I'd say the vast majority have made some sort of change over the past decade. And there are still big companies like Honeywell was here today, 3M was here today. There's some big companies that are doing things behind the scenes to try to become a lot more focused.
Joe, within your coverage, who do you think is best positioned heading into 2025?
Yeah, so at Goldman we have something called the conviction list. The name that I have on the conviction list is Parker Hannifin. They're great company, really well run. They're part of what I would call the new compounders. They're one of those companies that started making moves about a decade ago to really transform their business. 2/3 of their business is tied to industrial activity, and about 1/3 of their business is tied to aerospace and defense. And so they've been able to perform incredibly well, even at a time when the industrial markets haven't been a tailwind for them. So what we're expecting is at some point in 2025, their markets are going to inflect. That's going to be really, really good for their business. But I would also have to say, look, if you're levered to the power markets today, we've been in basically a structurally declining power cycle for the better part of the last 2 decades. And so companies like GE Vernova that produce heavy duty gas turbines, had a company here called Mirion today that's really levered to the nuclear industry. And you're in the first innings of a burgeoning cycle. Those are two companies to put on your radar screen.
And Joe, another company that's very popular with a lot of our viewers, you mentioned before the conversations with 3M's CEO. Clearly the market has been excited about the transition. We've seen that reflected in the stock price. How bullish are you looking ahead to 2025?
Yeah, so commented earlier when I had Bill on stage that I had to comment on his enthusiasm. He was full of energy. He said it was the coffee. I think it was much more than that. They're truly transforming that company. Mm-hmm. Now this is going to be a multi-year journey, but it seems like there is a lot that he can do to really transform the margins of the business. Mm-hmm. And then ultimately, they can become a much more focused company as well. They've already started doing some divestitures. They divested their healthcare business, Solventum, last year. You're likely to see more from them in the future on that front. And look, he's got a new leadership team in place. So every leader that was up there today has, outside of Bill's been there for a little over 7 months. Mm-hmm. CFO just started 3 months ago, and we have a new IR person that was announced yesterday. So they're doing a lot within the organization to change the culture. And I think this is going to be a multi-year transformation for Bill and for 3M.
Joe, thanks so much for your time.
It's great to see you, Shauna. Take care.
Oil ending the week with a loss on concerns of a surplus despite OPEC's recent decision to extend its production cuts. Joining us now, Yahoo Finance senior market reporter Inez Ferre. Hi, Inez.
Hi, Julie. Yeah, and at this rate that we're going, oil is going to be negative for the year. I'm going to pull up a year-to-date chart so you can see WTI down 4% this year, and also Brent crude down more than 6%. And for the next year, analysts are also expecting prices to go lower. I'll take that point in a second. But first, I want to note an important development this week that should have sent prices higher. That's OPEC's decision to extend its production cuts until April of next year. That's significant because the Oil Alliance has already repeatedly postponed bringing barrels onto the market. But take a look at the prices that we have seen over the last several days. Today, down more than 1% for Brent, WTI down 1.5%. We've been seeing a sell-off, and this is because of sluggish demand, particularly in China and also rising output from non-OPEC nations, including Western nations, the U.S., by the way, which currently produces about 20% of the world's oil supply. Analysts are switching their view to somewhat bearish for next year. B of A putting out its outlook earlier this week for 2025, expecting Brent to average $65 per barrel next year. And the analysts don't see massive price shocks like the ones that we've seen over the last several years, because they say that OPEC is sitting on the sidelines with spare capacity. And OPEC does want to bring those barrels back onto the market eventually. It doesn't want to keep losing market share to the U.S. Meanwhile, JP Morgan earlier this week also put out its forecast for next year, saying that Brent will average $80 this year. It'll slide to $73 next year. All of this is boding well for drivers for gasoline prices, because they're expected to hit $3 per gallon before the end of the year. Right now, they're at $3.03 on average, guys.
All right. Thank you, Inez.
Thank you.
Time now for what to watch next week. We're going to start off on the earnings front, and we got some big names in the software space reporting next week, including Oracle, Adobe, and Broadcom. Oracle announcing results for the second quarter on Monday after the closing bell. Analysts saying the company's results could underscore supply challenges, but see strong demand in AI workloads. AI will also be a theme for Adobe. They're reporting fourth quarter earnings on Wednesday. Analysts expecting the conference call to be centered around generative AI advancements and the potential for monetization of text-to-video.
Taking a look at the economy, monthly CPI, that's the Consumer Price Index for November. It's coming out on Wednesday. Economists forecast total CPI will tick up to 0.3%, while core CPI will hold steady at 0.3%.
And sticking with the economy, we're also going to be getting Producer Price Index data, or PPI. That's coming out Thursday morning. Both total PPI and core PPI expected to increase to 0.3 and 0.2%, respectively.
Well, from Intel CEO Pat Gelsinger retiring to Bitcoin finally hitting the $100,000 mark, it's been a wild week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
Bitcoin hitting a major milestone as the digital token powers past $100,000.
It's going to appreciate against the dollar forever.
So they're calling it the Paul Haul, which pulled Bitcoin across 100K.
Atkins could well be a very good SEC head.
The SEC will be in good hands with him.
There was clearly some sort of disagreement between Pat Gelsinger and the board.
You know, part of the reason Pat's gone is his insistence on trying to make Foundry work.
And it's going to be really difficult to find a CEO just from another tech company to come run it.
The November payrolls report coming in at 227,000.
My first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high.
We're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing.
The total number of jobs created have been unprecedented under this administration.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. But many companies are still hesitant to hire new workers, and many employees are staying put. This means that competition for the jobs that are available remains high, and it may take job seekers longer to find a new role. So what sectors are seeing growth, and how can job seekers find them? Joining me now is Andrew McCaskill, LinkedIn career expert. Andrew, great to see you on set.
Great to see you.
So let's start with that jobs report today, Andrew.
Yeah.
Because we were talking to economists on Yahoo Finance today, and their big takeaway was it kind of showed a labor market that, let's say, it's moderating, it's cooling, but no signs of real crashing. It kind of confirmed the story we've been hearing. But you spent, obviously, a lot of time thinking about this jobs market. How does it look to you? How strong, how healthy?
Yeah, I mean, look, there were not any surprises in what we saw. We saw that it was really stable, right? But the thing that I think is really interesting is that we saw most of the growth in three core sectors: in government, in hospitality, and we saw it in healthcare. Now, what that also means is that for all of these job openings that we're seeing right now, if you are in the market for a role and you're not in those industries, you got to start to kind of figure out what to do, because we're looking at a situation where there's going to be a lot longer lead times for people who are out there in the market looking for jobs. You've got boomers who are unretiring, coming back into the market, adding a new level of competition. So the competition is going to be really, really fierce for jobs easily for the next 12 to 18 months.
What are some takeaways then you have for people? Tips, tricks, guidance?
Yeah, I think one of the first things that people are going to have to do is actually sort of really prepare for the fact that it's going to be a longer tail job search. Are you really ready? The first thing people have to do is look at the tools that are at their disposal. Things like LinkedIn, is it updated? Have you added your skills to it? Do you have a new resume? If you were hiring right now, would you be at the top of your list, right? So use every tool in your disposal. Turn on open to work on LinkedIn. And then you got to think about your skills. The skills that people are hiring for are really, really important. Recruiters right now, over 43% are saying they're not even going to take people to the interview process if they don't have all the skills required for a role. That means you got to look across the bow at the jobs that are out there and say, do I have the right skills for these jobs? And how do I now go out and get those skills and fill in those gaps, or tell a differentiated story about how the skills that I have actually are transferable to these other opportunities? And your network matters. You're 4 times more likely to get a job at a company if you know someone who works there. And
why is that, Andrew? Because then you have a friend, an ally in there who's putting in a good word to HR?
You've got someone there who can help you decode the process and the culture. And keep in mind, this does not have to be your work bestie. You don't have to have gone to lunch with this person every day. It could be someone that you worked with 4 or 5 years ago. You say, hey, look, Josh, I'm looking for this role at Yahoo. Can you give me some perspective on it? Or maybe can you put in a good word for me, right? There's gradations to how much help you get, but in that process, 4 times more likely. That's a great subset to help you figure out it's worth it to reach out to that other person.
Let me ask you, so we were giving kind of general advice there. I'm very interested to get your take, what kind of advice you would give to younger viewers who might be listening right now. Maybe Andrew, they're just looking for their first job. Maybe they're already in their first job. What guidance would you tailor for that demographic?
Yeah, for younger folks, I think that the thing is that you get a mentor, somebody who's of a different generation. Most of the people who are going to be hiring, and they're going to be hiring managers, are not going to be from the same generation you are. So part of what you need to do is get a mentor or get a friend to help you decode how those people think about professionalism and the choreography of job hunting. That means that you're going to have to be on time. You're going to have to send a thank you note. You're going to have to be dressed professionally in a traditional way for that interview, probably because you've got 4 generations of people in the office together right now. And most of the people who are going to be hiring young folks are going to be people from those other generations and who did job hunting differently. And I think that you've got to really have an air game and a ground game if you're a younger person in the role right now. Also think about most companies are thinking your best new employee may be your current employee. So if you're looking for a job right now, companies are really holding on to talent, really good talent, and they're figuring out ways to say, hey, maybe take a stretch assignment over here or do a tour of duty over there. people want to hang on to really good talent, even if it means moving the chess pieces around on the board. Internal movement is a great alternative to going out finding a net new role for almost every employee. Even if you hate your boss, even if you hate your team, you could actually move to another team and love your new boss, love your new team at the same company.
Should you be going into work every day? Is that important, especially for a younger person who's just starting out?
If I had a kid who was a part of that sort of early career subset, I would say get ye back into the office, because I think about all of the things that I learned about building relationships. It is very hard to do that in a remote environment, especially if you've never had the experience before. I think you learn so much about, one, the art of work communication. You learn so much about just being able to lean into your coworkers, about collaboration, about culture. I'm almost 50, right? I could work remotely and still think about how to ingrain myself in the culture, how to collaborate, because I've done that all before. But many of the young professionals out there, they spent the better part of their sort of formative professional years in COVID bizarro world. Let's just be honest. And I think that now there's an opportunity. If you can go back into the office, I think people should grab onto that opportunity with both hands. Go into the office, make friends at work, learn how the business of work gets done in different parts of the organization. I think returning to office is great for young professionals.
Let me ask you a final question. I want to get your thoughts on this thing.
Yeah.
AI comes up a lot, right? Yeah. And there's a concern about you'll hear this, that this could be a kind of job killer. Others I've heard say AI is not going to take your job, but someone who actually understands the technology, can leverage the technology, that person could take your job. I'm just curious to get your thoughts on this.
Yeah, I think we're in the messy middle. We're all trying to figure out exactly what AI's impact is going to be on us at work. But what I will say, I truly believe that regardless of what the impact is going to be, it will impact us at work. The people who are going to win, the employees who are going to win, are the employees who are going out there and learning AI skills, learning the language, learning how to talk about it. And we've seen this on our platform. We've seen 3x the number of people who are taking AI and generative AI courses on LinkedIn Learning. But here's the rub. The true winner is that person who is going to learn those AI skills, learn how to talk about it, but who's also working on their human skills. Because the true winners are the people who are going to help in this big technology transformation. Tech transformations are culture transformations. And if you've got those human skills and those AI skills, that's a level of job security that we all should be looking for.
I don't see AI taking your job, Andrew, career expert. Broadcast reporter. I don't know.
I don't know that a bot could do what you do, Josh.
We'll see. I'll have you back soon for more advice. Andrew, thank you. Appreciate it. U.S. stocks closed the week mixed as the Nasdaq and S&P 500 popped to strong weekly gains. And Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. It was a really interesting mix and really interesting to see how the winners and losers shook out. I am looking at small versus large, David versus Goliath. And let's explore that theme here. I'm going to start with the sector action, and I'll show you the 5-day price action in the sectors, which is focused almost exclusively on the mega cap sectors. So number one, we have XLY. Guess what's in that? That's retail, that's consumer discretionary, but it has Amazon, it has Tesla. Number two is tech. We know what that has. Communication services, that has Meta. That also has Alphabet. That was up 2.6%. This is the S&P 500, so those were the only outperformers. Everything else was in the red here, led down by energy. And what's really interesting, we look at my leaders board here. Look at that, ARK Innovation Fund up 8.5%. Well, what's in ARK? The biggest one is Tesla, so arguably, that is mega cap influence right there. But then overwhelmingly, this is over the last 5 days. This is a lot of green, and these are smaller ones. So it almost seems like some of the smallest in tech and some of the largest in tech really had their day in the sun this week, Josh.
You mentioned Goliath. You mentioned the big names.
Yes.
Let's go into the weekend. What about the small names, the bite-sized guys?
IWM, I think that was negative. IWM is right here. That was 1.2% to the downside. So overall, small caps did not do that well. Some small cap tech, which we were just looking at, did. So go figure there. We'll have to see what happens next week, because it'll be really fascinating to see if this tech trend continues.
All right, Blickery point number 2.
We're making dollars, are we? So This has to do with the labor market, I believe. We did get that labor market today report, and I was sitting with Joe Bruce-Wellis. He is a chief economist over at RSM, and he and Sydney and I, we were over at Stocks in Translation talking about the labor market and inflation, and I asked him to compare services inflation over to goods inflation, and here's what he had to say about that.
If you take a look at service inflation, it's in that 4.7 to 4.8% year over year increase, and it's incredibly sticky. Why is that? Once wages go up, they tend not to go down. I mean, at the end of the day, that's what you really care about, right? Is 90% of our economy is services. Those prices have gone up, and let me say this again, they are not ever going to reset to 2019 levels.
All right, so these prices are not going back down to 2019 levels. We know that, but I think the hot wage number in today's report really gives you kind of a focus point for next week's inflation report.
Key inflation data on deck.
That is going to be Tuesday, and I'm going to be looking at that services inflation. Does it finally breach 5%? Let's remember that core is at 3.3%, and well, that's pretty big for core right there.
Yep. All right, Jared. Final point here.
All right,
Oh,
Bitcoin is channeling Star Wars.
Yeah.
I got this from social media. I'm not going to pretend that I noticed this myself, but I'm going to draw you a chart here. I'm going to go to my crypto heat map. I'm going to go to Bitcoin, up 5% over the last few days. I'm going to show you a 2-month chart with candlesticks, and you tell me, this is the Darth Maul candle. Do you see it right there? Do you squint and see it? I think you got it.
Squinting hard.
Yeah,
yes.
you got to know the prequels. I didn't grow up with this, but you got to know the prequels. And if you did, what this is showing though, and this is why I love candlesticks, this is showing both a rejection to the upside and also of the downside. And you combine that, you just have this huge range bar there. It was almost $20,000 for that one candle, 24-hour period. But the net effect here, we're going to the upside. So I wouldn't be surprised to see some new highs over the weekend. If we dip back below 100,000, that's kind of ominous. And then the low of this candle here that saw such demand from the underside, you definitely want to see that hold at about 92.
To you, Jared, as you look at the chart here, the levels you're watching would be what?
Like 92,000. 92,000 has to hold, but I'd like to see 100,000 hold over the weekend.
All right, Jared. Thank you.
All right.
Great to see you. Now we're asking for a trend coming right up on the other side. President-elect Donald Trump proposed tariffs are sending shockwaves through a variety of sectors in the U.S., and consumer electronics certainly aren't spared. The Consumer Technology Association releasing a report about the price increases consumers could see if Trump's proposed tariffs do go into effect. And joining us now is one of the people behind that report, Ed Bristois, Vice President of International Trade for the Consumer Technology Association. Ed, it is great to see you. So Trump is moving back into the White House. That means tariffs are front and center, Ed. What could that mean for the American technology industry?
It could mean lower sales. Tariffs are taxes that Americans pay when we import products into this country. And by and large, we import a lot of consumer technology products into this country, such as smartphones, laptops, tablets, video game consoles, desktop PCs. So if the tariffs that the president-elect proposed come into effect, that will increase prices. And Americans, as we found out recently during the election, they don't like higher prices, they didn't like inflation, and they may not like higher prices on consumer tech.
And yet, Ed, what's interesting is, if you look at some recent surveys and polling, including a recent one from CBS, it shows Trump's voters, and there are obviously a lot of them, overwhelmingly favor the idea of tariffs. What do you make of that?
Well, they may like the idea in concept. They may think that another country or someone else might pay the tariff, but that's not exactly how it works. Importers, companies in the United States, pay those tariffs, and if they can't absorb the costs, they pass the costs on to other entities and then eventually to the consumers. So consumers may think one thing, but in reality, they will be paying more if companies increase prices.
And yet the reality is, though, Ed, Trump has made it clear he likes tariffs. You listen to the team he's putting together there. It's clear Lutnick likes them, Bessent favors them. So how, bottom line, do you try and navigate that?
I think some of the incoming appointees have said, we believe tariffs are a negotiating tool to achieve other objectives, whether they're trade objectives, economic objectives, other types of policy objectives. So if they are going to use tariffs to negotiate new trade agreements or address barriers to trade in other markets, if they see them as negotiating leverage, that could yield better benefits for the American people at the end of the day. But if the tariffs are just put into place permanently, and there's no opportunity to open up new markets, to increase U.S. exports, to level the playing field, then that's going to be a cost on the U.S. economy over time, and it'll make our manufacturing ecosystem much more costly compared to our competitors.
I'm curious, Ed, if Trump really did impose tariffs on China the way he's talked about, how would you suspect Beijing might respond and react?
Well, we just saw Beijing retaliate this week in response to the new export controls on semiconductor manufacturing equipment announced on Monday by the Department of Commerce. And they have signaled that they're ready to retaliate against other measures too. So they imposed restrictions on exports of critical minerals like germanium and antimony and graphite. And we saw very clearly in 2018 and 2019, China did retaliate at that point in time with higher tariffs of its own, particularly on core U.S. exports to China, like in agriculture and chemicals. So I would anticipate that China is ready to retaliate again.
Ed, it's interesting to me because it's beyond tariffs. There has been this just obvious seismic shift, right, in politics in this country, in the Republican Party. I look at that party, and it's a very different party than the party I grew up with. And the values, what it's focused on, and you know this, you live and breathe it, it's economic nationalism, it's domestic manufacturing, it's this very strong view that China is not a partner, China is an adversary. And I'm just curious, someone who represents the American technology community, how you think that technology sector has to respond, react, evolve with that.
Look, we've been very clear for a long time that we need to address these unfair trading practices in China. So China is well known and it's very documented to have stolen intellectual property from U.S. companies. They forced technology transfer. The tariffs that were put into place in 2018 and 2019 were designed to address those behaviors, but China never changed its behavior. So in the technology sector, we want to do business with China, but we recognize there's a need to diversify supply chains. So many of our companies have moved to places like Vietnam or Mexico or other parts of Southeast Asia like Malaysia, or even in Europe or Japan or Korea. And we need good policy to support that supply chain diversification to keep costs down for the products our companies are designing and making so that consumers can buy them at affordable prices in the United States. And that's the trend line we'd like to continue.
And big, complex questions. Thanks so much for helping us think through it.
My pleasure. Thanks for having me on.
Stick around. Much more Asking for a Trend right on the other side. For our chart of the day, we are taking a look at inflation expectations between the political parties. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this is something that we have been watching and seeing this phenomenon, and it's especially measured by the University of Michigan's sentiment survey. They measure how different political parties, members of different political parties feel about the economy, and they also measure their inflation expectations. And it's that chart that was highlighted in a tweet by Michael McDonough, who's in the economics department over at Bloomberg today, looking at the flip that we have seen in inflation expectations over the next year between Democrats and Republicans since the election. So the white line you see here is Republican expectations for inflation, Democrats' expectations in blue, and independents in the sort of amber line in the middle here. Republicans, as you can see, going back to December 2021, they were feeling like inflation was going to remain much more elevated than Democrats were. We've seen them both trend down, but there's been that gap between the two, of course. Now, since the election, we have seen a flip. Democrats now, their one-year expectations at 3.2%. Republicans have fallen below them to 1.3%, and independents right in the middle, 2.9%. Incidentally, 2.9% is also where the average of the survey reading is. Well, why are inflation expectations important? Well, they have an influence on where inflation will actually end up, because customers and shoppers' willingness to pay certain prices. If you expect the prices to go up, well, maybe you're more resigned to those higher prices. You're more willing. You're not going to press back against them. At least that's one of the ways that these expectations can feed into where inflation actually ends up. And the political divide, as always, is quite interesting, especially since the election and that flip in sentiment here. So we'll see how this ends up actually feeding through and where inflation numbers actually end up. Of course, as we've been talking about, Josh, we've got CPI coming out next week on Wednesday. So expectations aside, We'll see where the number actually lands.
Yeah, it's interesting, Julie, because I've seen other polling and survey work showing that breaking down our views of not just the of the inflation have shifted, but in fact even views of overall economy has shifted too, depending on where you sit on the ideological aisle, which I guess just bottom line emphasizes this idea that your politics, that partisanship does play can play an important role in these sort of evaluations here.
Yeah, and I haven't seen an enormously long time horizon on these types of charts, but I am curious if that gap in perception related to political parties has widened over time. I would suspect it has, but I would love to see the numbers.
All right, Julie, thank you. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.